Welcome to another module of our course. Today we're going to speak about advanced trade management. And this is a topic that fills in some of the missing information in our entry technique. What I'm going to do on this lesson is talk about some theoretical aspect and then speak about real world investing. Now, we did speak about the ABCD patterns. ABCD. ABCD. In an ideal world, we will always be we'll buy at the C point, we'll buy at the E point, E here, F, buy at G, and so forth and so on. We'll always be buying pullbacks. But seeing as though we actually live in the real world, the market does not always present us that possibility. And what I'm speaking about is, for example, sometimes a market may go up, pull back, and go up and up and up. And this trend may last months without a pullback. That's what I like to call a strong trending market. The trend is not orderly, and it would be a pity for you to sit back if you didn't get in at this C point. It would make no sense for you to sit back and watch the market continue to go up and up and up without getting into it. A huge mistake that some traders make is that they have the perfect entry point, and because they did not get in the market at this exact point, and they may recognize that the market is starting to move up, they will never get back in to the market. And they say, oh, it's too far from my buy point, so I'll watch the market. I'll wait for a pullback, or I will sit this one out. And more often than not, the one you sit out is the one that may get a parabolic move up the upside. And you would have missed all this move because you did not. This looks like a man. Because you did not because you did not get in at exactly that point. And that, in my opinion, is an error. So let me buying. You buy high when you are not buying at your ideal price. You may buy high once you realize that we're moving up to, you have A, B, market came down to C, and you are moving up to a D point, which you do not know. And the market is going up and up and up. Now, where would you enter a market like this? First, we have to recognize that this is a riskier trade, because at any moment, the market could pull back like this. So you have to, when executing a trade like this, you have to realize that it's a risky trade or a riskier trade. But because it's a riskier trade, that does not mean you must execute it. You must not execute the trade. So the strategy is, what I like to do is I like to wait. First of all, strategy A, you can, when you see the market going up, you can just get in. It may sound arbitrary, but if you have done your analysis and you realize that there is no overhead resistance that will inhibit the market, what you could do is just get in. And not having overhead resist is important, because we're not speaking about market that generally has overhead resistance close to it, meaning may have resistance here and the market may be here. We're not talking about buying when there's clearly resistance here. Whereas normally with this strategy, we're employing when the market is making new highs. Either new highs or the past resistance was years ago. So you may have a market that came down like this. And started, but this resistance over here was, let's say this is the daily chart. This resistance over here could be 4 or 5 years ago, while it's making new highs here. So what you could do is just get in, but recognize that market could pull back. This would be for you to make, and I only have to do so heavy trending. And also recognize another tactic to use with this trending market is to wait for a doji star to form. As you can recall from Japanese candlestick, a doji star would be like this. So the market may be going up. This is my candlesticks. And then it forms a doji. And a doji normally means indecision. So what you could do is wait for the doji star. And if you close above this doji star, you could use that as your entry point. And what normally happens when you have a doji and a high close above that doji, the market normally continues to go. But that's the concept of buying high. And you may ask, where would your stop loss be? Your trailing stop would be the same with the chandelier exit. So if you bought here, the chandelier exit may be below here, and you put your stop below the chandelier exit. And you will trail the stop, the stop up. Another thing you can do is also risk less on a trade. So if your risk management plan, you had stated that you would risk 2% per trade on a pullback to this level, what you could do on trades like this is risk just 1%. Or if you decide to risk 1% on your trade, on a trade like this, you could risk 0.5% of your equity, 0.5%. That would be a prudent strategy. And let's just look at an example of back when. Let's just look on this uptrend in gold. Suppose you did not get in. You did not get in at this low point in gold, and the market surged above this resistance level here, and was moving upwards like this. Now, as I said before, recognize that it's a riskier strategy, but you could reduce your actual contract size, and you see a small consolidation here, and you would have bought above the consolidation. Or let's see if we see a doji. This pattern here was not exact. This candle here is not exactly a doji star. It's close enough, and you had a breakout above the doji on this candle, and the market kept going up. You had another doji here, and the market closed above that point and increased. But recognize when you do these trades, recognize that the trend could end at any moment. And if the trend does end, what normally would happen is that the market may just pull back to your ideal buy point, and then you could buy at that point. So even though you may have taken a small loss, you would then gain a good, or have a good buy point to enter the stock. But recognize, now let's also look at this rally, the great rally in the S&P 500. I mean, the market closed above the resistance point, came down, tested it right here, didn't come exactly down to the point, but came around this region here, tested it, and kept going up. So what you could have done, as I said before, was just enter the markets. You see a small consolidation pattern here, market broke above it. You could have entered there, and you just trail your stop down by the chandelier exit, or you could have waited on a doji. The first doji was here. Market closed above that doji star and went up. So that's the concept of buying high. You don't have to employ this strategy, but I mean, sometimes you will just see a market run away from you, and it will be a good strategy to do. Another filter you could do is to see if the market is near the monthly R2 pivot point resistance. If it's near the monthly R2 pivot point resistance, it's probably, you may not want to exit the market. as I said, a trade like this is very subjective, and it's very, the chances of it gaining success is 50-50, but it will allow you to stay in big trends and not let trends get away from you. So that's what I call a trend continuation. Another type of trade is what we call a channel, not a channel, sorry, a triangular consolidation. And let me just use the example of gold. It's a weekly chart of gold. And what, as you can see here, the market traded above the downtrend line resistance, came back, tested the resistance, and took off from there. Now, how would you trade that? You could trade that by waiting for a break of the trend line and waiting for, you have the initial break and you have another bar that closes above the initial break. That would indicate to me that it's probably a strong break. This is a triangle, and your stop loss again would be below the chandelier exit. The market pulled back, finding support at the breakout point. What was former resistance now becomes support. Here, this is the resistance. This was acting as resistance. This black trend line. The market broke above it, came back down to support, and went up again. Now, this does not always happen. Sometimes the market break out of a triangle and then just continues up. And if you wait for a pullback, that pullback may just never occur. So it's good to, well, what I like to do is, this will be the signal bar. Let me just clean it. On the initial break would be the signal bar, and I'll wait for a close above that break and put my stop either below the chandelier exit or find a swing support point. Like looking on this would be a good swing support point to put your stops. And when the market takes off, you will then move the stop up with the chandelier exit. Another key concept that I want to speak about is using the lower time frame to trade a higher time frame, or basically trading multiple time frames. So you may say on this chart here that gold, this is another strategy you could use. Gold broke out of a triangle here, and you are looking for a good entry point. You could then fine tune your entry point on the daily chart. So this was in 2008. This will be the trend break. As you can see, the market pulled back to just above the 50% retracement level and then took off. So this is you could use the daily chart to fine tune your entry if you saw prices at this point. Basically you saw this. Say you missed the triangle break, you weren't paying attention to the market, and then you see that the market is pulling back. You could do the regular pullback ABCD type entry. And once you fine tune your entry on the daily chart, you could then use the weekly chart for your exit. You could use a weekly chandelier exit for your chart, for your exit. Give you another example of using a multiple time frame. We could see this was a monthly chart. Coming back down, we saw the S&P 500 test support. Test support down here. Came up, gave a buy signal, and you could have fine-tuned that entry by seeing this head and shoulders bottom pattern that happened. This is roughly the shoulder area here, the head, the right shoulder. But these, no, I know folks that just love to trade the weekly charts because they love to be in positions for a year, 2 years. That's no problem. And it brings up what I like to call multiple time frame investing, that some people may hold an index. For example, they may see a buy signal here on the S&P 500 and they will purchase it on the weekly chart. And I use this strategy myself. Make a purchase on the weekly chart and use the daily chart to trade maybe the S&P 500 or the Dow Jones Industrial Average. So they would hold one of the indices, a trade for a long period of time, and then hold the Dow or the QQQs for the 3-month, 4-month time period. And that often works pretty well also. So just to repeat, it's good to look on the weekly charts because sometimes you will see something forming on a weekly basis and you can trade that weekly chart and hold on to that position a year or two. It's very good if you really catch a market cycle in, for example, stocks. Like if you caught this bottom, which was fairly easy to catch in stocks, because market came down to support, channel support, and it closed below it once, twice, and then snapped right back. So that means support basically held. Now, another type of trade I would like to speak about is a channel break. Now I have a channel pre-drawn. Let me just tell you how to trade the channel. So you have a channel on the daily chart or weekly chart or whatever, then it breaks below support. The way how you trade this is you will sell on the break of support. Well, if this is a downtrend, so you sell on the break of support. If it was a buy, you would buy on the break of support and then use your chandelier exit to trail stops down as the market moves in your direction. And now I'm giving you all of this in theory, but when it does actually happen in the market, I know a lot of traders will get cold feet and say, "Oh, let me not enter. Maybe we'll snap back." But it's essential to realize that losing is a part of investing, and you cannot invest with scared money. The investors who are ruthless, who take their trades, who follow the system as they have designed it, are the ones who win. Because I am telling you a system here, and there may be some people who actually understand the system, but when it comes to actually executing the plan in the market, it all falls apart, and they just cannot pull the trigger because the markets really are uncertain. No one knows specifically what the future entails in the market. But when you use these principles I have outlined, your chances of success are much greater. You're actually investing with a system as opposed to just investing willy-nilly. And just to repeat, you should probably use a smaller trade size to trade channel breaks and continuations. Let me just speak about another phenomena that happens in the market all the time, and it happened. Let's look on the rally in S&P 500. We see that the market closed below the chandelier exit. One closed below, then immediately snapped back up and made a new high. When you see that, again, you could re-enter the market. Do not be afraid to ever re-enter the market and use the chandelier stop again as your exit. A close below the stop for your exit. And as you can see, if you re-entered, you would have been in, if you entered here, you'd have been in here until 154. We'd have taken a couple of ticks out of the market. Another buy signal. You'd have been up again up to this point here in May. So as I said before, do not be afraid to re-enter the market. And this will definitely be a harder trade to take. And to fine-tune your entry on a re-entry of a chandelier exit, of a pullback, you could use a 4-hour chart to get a good entry. Maybe use a ABCD trade on a 4-hour chart to fine tune that entry, and then use the daily chart for your exit. Okay, the other type of trade I'm going to speak about is a reversal. Now, I do not advise that you trade too many reversals because you could lose a lot of money when you're wrong. But this is an example of a trend reversal in gold, and we see that the market entered a channel. And you had a top here, and what would have been prudent is to never try. First of all, let's back up a little bit. Just get my eraser. Never try if it's A, B here, pull back to C, market is going up. When I'm talking about a reversal, never try and see where this D point is. Never, ever, ever try that. Because you may think that D point is here and it continues to go up. A lot of investors sell this level. Maybe they think market will stop here. They sell the level, the market goes up to here. They say, oh, it cannot go up any further. Just no way. They sell again. Market continues to go up. They sell again. The market continues to go up. And they normally get in this trap with what I call the pivot point support. They may calculate, this is a common error, they may calculate monthly R2 here, weekly R2 here, and it's a resistance point. And they may say, oh, because the monthly R2 is here, the weekly R2 is at this point. And you may even have, we haven't spoken about it, but Fibonacci extension level that the market can often go to. They may say, okay, the market could not move above here and let me sell. But you remember, pivot points are very good in pullbacks and not necessarily when the market is trending up like this. So don't get into the habit of trying to anticipate where the key point is. So when I'm trading a reversal, and this can easily just be shown on the whiteboard, A, B, C, you're not going to try and guess the D point. And D could go here and you sell again. And then you sell again. Or in reverse, the market goes down, you buy. Then it goes for, then you say, oh, it cannot go any lower than here. And buy again. Then it goes, may tick up a little, goes down. Then you buy again. That's not what I call a reversal. You need more evidence. So what happened? The evidence could be now that the market goes up, comes back, goes up, comes back, then goes up to this former area of resistance. And then you may calculate that the pivot point resistance level is here, weekly resistance is here, and this prior resistance is here also, and then you'll wait for a candlestick reversal pattern. That could be a trade you take. They may come down, and then even better is if it does a triple top and you get a candlestick reversal pattern. But these are the only types of reversals against the trend that I like to trade. And we saw this in that happened in gold. That's, that's not good. Where the market broke down, market came up to this resistance point, and we got a sell signal, and then the market broke downward. But please, also when you're trading reversals, risk only half of what you normally risk, or even a quarter of what you normally risk on a regular trade, because it could go against you. This is where really your risk management techniques come into play. So a possible system you could use is that you rank your trades. You may say this would be, you have a type A trade, which is the ABCD pattern. You'll be, when you have 4 or 5 quote unquote pieces of evidence, you will risk 2%. If you only have 2 pieces of evidence, you may risk 1%. If it's a reversal, you may only risk 0.5%. That's also a very good strategy to use. Or if you are aggressive, reversals, you risk half of what you normally use, and every other trade you risk maybe 2% or so. I mean, this is just something you have to figure out yourself. I cannot tell you what to do in that situation. So we will have more information about advanced trades in our webinars that we will host, because they can be a bit difficult to understand at first. But if you have any questions, please send me an email at bayon@acestrading.com, and I will respond, especially to some of these more advanced techniques. And I will see you on in the next module. Thank you.